Let me say something that might sting a bit. If you've been trading for a while and you're still not consistent, it's probably not because you're bad at trading. And yeah, I know you've heard the stat before, 95% of Forex traders fail. But what nobody tells you is why that number stays the same year after year, even with better tools, better platforms, and more information than ever. But here's the crazy part. Most traders don't fail because they're wrong. They fail because they're doing exactly what everyone else is doing. And nobody ever explains why that path is almost designed to wipe you out. If you've ever thought, I understand the strategy, so why is this not working? Or I'm winning trades but somehow still losing money, this video is for you. Because in this video, I'm not going to motivate you. I'm not going to tell you to believe harder. I'm going to break down the real reasons traders fail. The stuff that actually happens behind the scenes, the mistakes that feel harmless at first but quietly destroys accounts over time. And fair warning, once you see this, you won't be able to unsee it. So if you're serious about trading, not gambling, not hoping, watch this properly because this might be the video that finally makes everything click. Let me be honest with you for a second. If you're in Forex right now, there's a very high chance you're being lied to. And it's not even on purpose. Everywhere you look, it's the same story. Just control your emotions, just trust the strategy, just stay disciplined. But if that was really the problem, then why are smart, hardworking people still losing money year after year? Here's the truth nobody likes saying out loud. Most traders don't fail because they're lazy, stupid, or undisciplined. They fail because they were taught the wrong things in the wrong order. And if you don't fix that early, the market doesn't care how motivated you are, it will eventually expose you. Before we go through these reasons why 95% of traders fail, let's clear something up first, because this 95% fail stat gets thrown around a lot and is usually misunderstood. When people hear that number, they imagine traders just losing every single trade and getting wiped out straight away. That's not what actually happens. Most traders don't fail on day one. In fact, a lot of them start off doing pretty well. They win a few trades, they feel like they've cracked it, some even double a small account early on. So when we say 95% fail, what we really mean is this: they never reach consistent profitability. Failure in trading usually looks boring, not dramatic. It's slowly bleeding an account, it's making money one week, giving it all back the next. It's being stuck, break even for months or years until you eventually quit. And that's why this stat never changes. Because the market doesn't punish you immediately, it lets you survive just long enough to build bad habits. And then it takes everything back. So the real question isn't why do traders lose? Everyone loses. The real question is, why do so many traders never make it past this stage? And why do they stay stuck in that cycle, winning just enough to stay hopeful, but never enough to move forward? And that's where the real reasons begin. Reason number one, they start with money, not skill. This is where almost everyone goes wrong right at the beginning. Most people don't enter trading asking, how do I become skilled at this? They ask, how much can I make? And I get this, money is the whole reason people are here, but starting with money is like trying to build a house by choosing the paint color before you've laid the foundation. Think about it. The first thing new traders usually do is open a small account, maybe £100, £200, and then they start hunting for strategies that can flip it. Not because those strategies are good, but because they're fast. So instead of learning how the market actually moves, they jump from setup to setup, indicator to indicator, YouTube video to YouTube video, always looking for something that can make money now. And here's the dangerous part. Early wins don't teach you skill, they teach you confidence. You might catch a few good trades, you might double that small account, and now you're thinking, okay, I've got this. But what you've really learned is how to survive in a very specific market condition, not how to trade. Skill in trading isn't about winning a few trades. It's about understanding why a trade worked, why it failed, and whether you take it again if the outcome didn't matter. Most traders never slow down enough to build that skill because focusing on money pushes you to rush, to overtrade, and to skip the boring part. Journaling, reviewing, and repetition. And the market eventually exposes that because when conditions change, and they always do, by the way, the trader who built skill adapts, but the trader who chased money panics. And that's why so many traders feel like they were doing well until suddenly they weren't. Reason number 2, no actual edge, just random setups. Once traders get past that first phase where they're chasing money, they usually think they've found the solution. They say, okay, I just need the strategy. So they start collecting setups, support and resistance, indicators, patterns, maybe a little bit of ICT, maybe a bit of SMC, maybe a strategy they found in a comment section. But here's the problem. Having a strategy does not mean you have an edge. An edge is not something that looks good on a chart. An edge is something that works over a large sample size. Even when you don't feel confident, even when you're in drawdown. Most traders never build that. They take 10 trades, lose a few, get uncomfortable, and immediately assume the strategy is broken. So they switch. They'll have new rules, new indicators, new time frame, but the same outcome. What they're really doing is trading randomness, then expecting consistency. And the market doesn't work like that. Probability only shows itself over repetition, but repetition feels boring, and boredom is exactly where most traders quit. This is why you'll hear people say the strategy works sometimes, but not always. That's not the issue. No strategy works all the time. The issue is they never stayed with one approach long enough to prove whether it works at all. An actual edge is boring. It's doing the same thing again and again, same conditions, same rules, same executions. And most people can't do that, not because it's hard, but because it doesn't feel exciting. So instead of refining one edge, they keep searching for a better one. And years later, they still don't trust their trades because they never gave themselves anything solid to trust. That's not a strategy problem, that's an edge problem. Reason number 3, risk management is ignored or misunderstood. Now, here's the part that hurts, because this is where most traders don't just lose money, they lose time. Risk management. And I don't mean that thing people say like, yeah, risk 1% a trade. I mean actually understanding what risk is doing to your account behind the scenes. Because most traders think trading is about being right, but trading is not about being right. It's about surviving being wrong. Let me give you a simple example. Say you start with £1,000. If you risk 1% per trade, you're losing £10 when you're wrong. That's annoying, but you can take 10 losses and you're still alive. You can still show up tomorrow and trade like nothing happened. But most traders don't do that. They'll risk 5%, 10%, sometimes more, especially after a loss. So now one bad trade isn't £10. It will be either £50, £100, or £200. And then they do the thing that sounds logical but is actually deadly. They try to make it back quickly, so the risk goes up even more. And suddenly you're not trading your strategy anymore. You're trading your emotions with the strategy as an excuse. Now, here's what people don't realize. The bigger your loss, the harder recovery becomes. If your account drops 10%, you need about 11% to get back to break even. Not too bad, right? But if you drop 50%, you now need 100% just to get back to where you started. That's not motivation, that's maths. And this is why traders feel like they're on a hamster wheel. They'll have a good week, then one bad day wipes it, then they spend the next 2 weeks trying to recover, then another bad day wipes it again, not because they're terrible at trading, but because their risk is so aggressive it doesn't allow normal losses to exist. And losses are normal. Even a very good trader can have a losing streak. A strategy with a real edge can still lose 3, 4, 5 trades in a row, but if your risk is too high, that streak doesn't feel like a normal drawdown. It feels like the end of the world. So your psychology breaks. But because your risk is forced, that's why I say risk management isn't just protection, it's the foundation. Because with proper risk, you can actually let your edge play out over time. Without it, even a profitable strategy will still blow your account because you never gave yourself enough room to be human. Point number 4, overtrading and dopamine addiction. Now, once risk is off, this is usually what comes next? Overtrading. And what most people don't realize is that overtrading isn't really a discipline problem, it's a dopamine problem. Your brain is wired to seek reward, and trading platforms are basically perfect dopamine machines. Every candle that forms, every tick, every little move up or down, your brain is waiting for something to happen. So when there's no real setup, your mind starts filling in the gaps. This looks like it might go. If I don't take this, I'll miss it, or I'll just take a small one. But those trades aren't planned. They're emotional responses disguised as analysis. Here's how it usually plays out. Say you take one clean trade, win or lose. Then instead of stepping away, you stay on the charts, watching, waiting, and slowly your standards drop. What needed 5 confirmations earlier now only needs 2. What you wouldn't have touched yesterday suddenly looks good enough today. That's dopamine talking, not your edge. And the worst part, overtrading often works at first. You'll catch a few moves, feel productive, feel active, but activity is not progress. The more you trade, the harder it becomes to stay objective. Losses feel personal, wins feel like validation. So when you lose, you want another trade, not because it fits your plan, but because you want relief. That's where revenge trading starts, not as anger, but as discomfort. And this is why so many traders say, I know what I should do, I just don't do it. It's not a knowledge issue, it's that their environment is constantly pulling them back into the charts. Professional traders don't win because they trade more, they win because they trade less, but better. They wait, they get bored, and they're okay with it. Most traders never learn to sit in that boredom, so they keep clicking. And over time, those extra trades, the unnecessary ones, do more damage than the losing trades could ever. Reason number 5, no process, only outcomes. This is probably the sneakiest reason traders fail, because on the surface it sounds logical. Most traders judge themselves by one thing. Did I make money today? If the answer is yes, it was a good day. If the answer is no, it was a bad day. Simple, right? Except that way of thinking slowly destroys your ability to improve, because when your focus is only on outcomes, you stop paying attention to how those outcomes happened. Let me explain. You can follow your rules perfectly, take a clean setup, manage risk properly, and still lose. That's trading. But instead of seeing that as a good trade with a bad outcome, most traders see it as a failure. So next time they hesitate, they tweak the rules a little bit, they second guess the setup. But on the flip side, you can break every rule, overtrade, get lucky, and still win. And that win feels amazing. So now your brain starts rewarding the wrong behavior. This is called outcome bias, judging decisions based on results instead of process. And it's one of the biggest reasons traders never stabilize, because over time, they're not reinforcing discipline, they're reinforcing whatever made money last. That's why trading feels inconsistent. One week you're confident, the next week you don't trust anything, because there's no solid process underneath, just reaction to the last win or loss. Professional traders flip this completely. They don't ask, did I make money today? They ask, did I execute my plan? If the answer is yes, it was a successful day, even if the trade lost, because they know something most traders don't. Money is a byproduct of process. When you get the process right, entries, risk, execution, review, the results take care of themselves over time. But if you skip that and chase outcomes, you're always guessing, and guessing feels stressful. And that stress is what pushes traders right back into overtrading, revenge trading, and rule breaking. Not because they don't care, but because they never gave themselves a clear process to trust. Reason number 6, they copy, don't understand. At some point, after enough losses, most traders do something that feels smart. They stop trusting themselves, and instead of building understanding, they start copying. They'll copy strategy, they copy entries, they copy signals, they copy what someone else is doing because it feels safer. And in the short term, it actually works. If someone else is telling you where to buy, where to sell, where to put your stop, you don't have to think, you don't have to doubt yourself, you just follow. But here's the issue no one talks about. You can copy a trade, but you can't copy context. You don't know why that trader took that trade. You don't know why they're seeing on or what they're seeing on a higher time frame. You don't know what rules they're breaking or why they're allowed to break them. So the moment conditions change, you're lost. This is why so many traders say things like this strategy stopped working or the mentor didn't explain this part. What they're really saying is, I never fully understood it, I just followed it, and following works until it doesn't. Understanding is different. Understanding means you know what you're looking for, and just as importantly, what you're not looking for. It means you can miss a trade and feel calm. It means you can take a loss and know it was still a good decision. It means you can adapt when the market shifts instead of panicking. Copying robs you of that because every time you outsource thinking, you delay your own development and the market eventually forces independence. At some point, you have to be able to sit in front of a chart and say, I know what I'm waiting for and I know why. Until then, trading will always feel shaky because your confidence isn't coming from skill, it's coming from someone else's opinion, and opinions disappear the moment things go wrong. And finally, reason number 7, they quit too early or scale too fast. This is where the journey usually ends for most traders, and it's almost always happens in one of two ways. They either quit too early or they scale way too fast. Let's first talk about quitting first. Trading has a really brutal learning curve. At the start, everything feels confusing, then things start to make sense, and right when you feel like you're getting closer, progress slows down. This is the phase where your trading is clearer, your entries are better, but the results aren't still amazing. And that's the dangerous part because it feels like you've put in enough work to deserve consistency, but the market hasn't rewarded you yet. So doubt creeps in. Maybe this just isn't for me. Maybe I've wasted my time. Maybe everyone else just has something that I don't. And a lot of traders quit right there, not because they failed, but because they were closer than they realized. Now, the other side is just as destructive, scaling too fast. This usually happens after a good run. A few clean weeks, confidence is high, the strategy feels solid, so they increase size. Not gradually, emotionally. They go from risking small, controlled amounts to risking amounts that actually matter to them. And that changes everything because now every loss hurts more, every drawdown feels heavier, and the same strategy that felt easy suddenly feels stressful. The trader hasn't changed, the psychology has. Skill develops slowly, size should grow even slower. Professional traders don't scale because they feel good, they scale because their data tells them it's time. But most traders skip that part. They treat one good month like proof instead of seeing it as just one data point. So, whether it's quitting early out of frustration or scaling too fast out of confidence, the result is the same. They leave the game before the edge had time to compound, and trading doesn't reward intensity, it rewards patience over time. The ones who make it aren't the most talented, they're the ones who stayed small, stayed consistent, and stayed long enough for everything to finally align. So, you may be asking, what does the 5% do differently? So, after all of that, here's the part most people expect: some secret, some hidden strategy, some indicator no one else knows about. But that's not the truth. The 5% don't win because they're smarter, they don't win because they predict the market better. They win because they approach trading completely different. The first thing they do differently is they think in probabilities, not predictions. They're not trying to be right on every trade. They're trying to execute the same idea well over and over, knowing that some trades will lose and that's okay. Second, they respect risk like it's non-negotiable. They don't adjust size based on emotion. They don't increase risk because they feel confident. Risk is fixed, boring, and protected because they understand that survival is the real edge. Third, they trade less, they wait, they miss trades, they sit through boring sessions, and they're fine with it because they know their job isn't to be active, it's to be selective. Fourth, they track everything, not just wins and losses, but execution. Did the setup meet their rules? Did they manage risk properly? Did they follow their process? This is how confidence is built, not through wins, but through consistency. And lastly, the 5% stay in the game long enough for all of this to compound. They don't quit after a bad month. They don't overreact to a good week. They understand that trading rewards time in the market, not intensity. There's nothing flashy about it. It's quiet, it's repetitive, it's patience. But that's exactly why it works, because while everyone else is searching for the next breakthrough, the 5% are simply doing the basics exceptionally well for longer than everyone else was willing to do so. So if you take one thing away from this video, let it be this. The reason 95% of traders fail isn't because they're lazy. It isn't because they're not smart enough, and it definitely isn't because they didn't want it badly enough. They fail because trading was never explained to them as a long-term skill, only as a way to make money. And when you approach a skill like a shortcut, the market eventually corrects you. Consistency doesn't come from finding something new. It comes from committing to something simple and doing it properly for long enough. Managing risk, trading less, focusing on process, building understanding instead of copying, staying small long enough for experience to actually matter. That's the real game. So if you're watching this and thinking, this explains a lot, good. That means you're on the right path. Use this as a checkpoint. Ask yourself, am I building skill or am I chasing outcomes? Am I trading with the process or reacting to the last result? If this video helped you see trading a bit more clearly, do me a favor, drop a comment and tell me which part hit home the most. And if you want more content that breaks trading down honestly, without hype or nonsense, hit the subscribe button, because this channel is about helping you stay in the game long enough to actually win.